Welcome back to Investing Talk Podcast.
Today we're looking at Open Door Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Open Door right now presents one of the most interesting
And frankly, confusing.
confusing investment profiles on the market. It's like a textbook case of this massive technical explosion colliding with some, well, very challenging fundamentals.
It's more than a collision, it's a car crash of expectations.
Mm-hmm.
I mean, you look at the momentum, the numbers are they're almost unbelievable. This stock bottomed out near 50 cents last year.
15 cents.
We are talking about a surge of over, 1,200% from that 52-week low.
Yeah.
And year to date, it's up over 430%. That kind of move,
Yeah.
that's not driven by a P&L statement.
No, it's pure retail enthusiasm. It's short squeezes. It's all about anticipating that housing recovery.
Right.
And it really shows the incredible power of narrative in this space. I mean, they still have immense scale. Trailing 12-month revenue is sitting right around $5 billion.
They're moving thousands of homes.
But this is the critical point. They are generating substantial net losses right alongside that revenue. We're talking, historically between 317 and 368 million over the TTM period.
So scale without profit is just burning cash faster.
It's just a mechanism for burning cash.
And that's why the analyst intent is so jarring.
Yeah.
You have the stock trading between, $7 and $8 right now? Meanwhile, the average professional analyst price target is
That's way down.
drastically lower.
Yeah.
Like in the $1.88 to $2.21 range. I mean, that is a chasm.
It is.
What does that tell us? It suggests the street is either extremely pessimistic.
Or they're just completely discounting the catalysts that are fueling this rally.
Right.
I think it's a bit of both, but it's mainly rooted in the painful history of the iBuying model. You have to remember the core business is incredibly sensitive. Open Door is essentially a market maker for houses. They take all this inventory onto their balance sheet.
Which works great when rates are falling and prices are going up.
Exactly. Which is not the world we're in right now.
Not at all.
In an environment with higher interest rates, they're already thin gross margins. They just get squeezed instantly.
And they are razor thin.
Historically, we're talking about margins hovering in the 7.2% to 8% range.
That leaves zero room for error if they misprice a few hundred homes or the market dips even a little.
That margin is gone. It just evaporates.
But to their credit, it does look like management has learned some hard lessons. You can see it in their operational discipline.
Mm-hmm. You can.
Look at the acquisition volumes. Back in 2021, at the peak of the frenzy,
They were buying everything.
went to 15,000 homes a quarter. And now,
It's a huge pullback. They're acquiring under 4,000 homes per quarter now.
that's a massive shift.
It's a necessary risk-managed step. They've gone from, maximizing volume to maximizing control. And this leads right into their strategic pivot, which is, it's the key to justifying any future valuation.
The whole AI-driven asset-light model.
Exactly. The goal is to fundamentally change how they make money. Shift away from just being a high-volume, thin margin flipper.
That sounds great on paper. But practically, what does that mean? How does AI actually improve the margins on buying and selling houses?
It's all about their proprietary data, their pricing algorithms. Think about it. Open Door has processed millions of transactions, generated millions of offers.
That data is their moat.
It is. And the AI pivot aims to leverage that for two things. First, reduce how long they have to hold inventory, which lowers costs.
Okay, makes sense.
And second, to dramatically decrease the number of mispriced acquisitions if they can get the price right and speed up the cycle.
Then that 7.2% to 8% margin suddenly looks a lot healthier.
Much healthier. They're basically using their experience to get better at not losing money.
It's a survival mechanism.
Yeah.
And management put a date on this, didn't they?
They have. The projection is that if they can execute perfectly on all this, combined with cost cuts, they could potentially reach cash flow break-even sometime in 2026.
So that's the timeline. That's what every bull is hanging their hat on.
That's the entire long-term thesis. It's aggressive, but, they still hold that key market position.
They're still the biggest pure-play public iBuyer out there.
The brand recognition, the data, it's all powerful stuff, assuming they can actually deploy it for profit.
Okay, and speaking of management, we have to talk about the absolute firestorm of activity we saw recently.
Oh, yeah.
Especially in November. This wasn't just housekeeping. This is a complete structural overhaul.
It was, and it happened right as new leadership came in.
Why?
Let's unpack that.
Yeah.
So Kaz Najatian formally took over as CEO in October 2025. A critical moment, a clean break.
And that was immediately followed by new board members and that big PI-PE investment.
Right, from key insiders and Khosla Ventures. I mean, when insiders and big VCs put their own money in, that signals some confidence.
It stabilized the ship. But then November hit.
And things got incredibly complex.
First, the at-the-market, or ATM, equity program. That raised about $198 million.
And then, almost instantly after that, they announced a huge direct offering, over 180 million shares priced at $6.56.
That is serious dilution. Normally, that would just tank a stock.
But this is where you have to look closer at the ballet they performed. Because while they did that offering, they paired it with an equally large concurrent transaction. They agreed to repurchase about $264 million of their 2030 convertible notes.
So they're selling new equity while buying back their own corporate debt.
Exactly.
What's the strategy there? Why not just raise the cash?
They're swapping debt for future equity, and they're doing it in a highly efficient, cash-neutral way.
Cash neutral.
Yeah. When you net out the cash from the offering against the cash spent buying back those notes, the net change to the company's cash is basically zero.
So they're using the market's excitement to clean up the balance sheet.
Right. They're reducing their debt load without burning through their operational war chest. It dramatically reduces risk and buys the new team a lot more runway.
Well, that's actually pretty clever. It's a sophisticated deleveraging move. But wait, it got even more complicated, right?
It did.
The warrant dividend distribution, Series K, A, and Z.
That's the third layer. And this points to their future strategy. These are basically options for current shareholders to buy shares at much higher prices.
Like $9, $13, and $17.
Yes. The immediate impact is it gives the company a defined way to raise hundreds of millions more down the road if the stock keeps going up and those warrants get exercised.
It's optionality for future capital raising without doing another messy offering right now.
Exactly. So the whole package. The CEO change, the offering, the note repurchase, the warrants, it's all about stabilizing the capital structure and setting targets.
And the settlement for all of this was expected around November 21st. So this is all very recent, very defining stuff.
Absolutely defining. So now that the foundation is supposedly stable, we can look at how the market is actually reacting.
And the market is loving it. If we go back to the technicals, the setup is incredibly strong.
It is.
Opendoor is trading comfortably above all the key moving averages, the 20-day, the 50-day, and the 200-day.
That confirms a very robust short-term uptrend. And momentum indicators like RSI and MESH-ED, they're backing it up too.
They're not showing that it's critically overbought, not yet anyway.
And the price action, it suggests high volatility, but with some defined levels. Traders are looking at, $6.50 as key support?
Which is right around that offering price.
And resistance is sitting around that psychological $10 mark.
And the volume.
Yeah.
The elevated average volume tells us this isn't just a brief retail spike.
No. High volume like this suggests institutional accumulation is probably happening. Large funds are starting to position themselves
For that potential cyclical recovery, which is the ultimate macro tailwind here, isn't it?
It's everything.
Opendoor is so intensely rate sensitive, arguably more than almost any other real estate stock.
We saw the perfect example just recently. The stock spiked 12.5% in a single day.
Just because of some dovish comments from the New York Fed.
That's the bull thesis in a nutshell. Opendoor is essentially a leveraged bet on the Fed easing if rates stabilize or drop.
Their cost of carrying inventory drops, housing demand improves, and suddenly that 2026 break-even goal seems a lot more achievable.
Much more.
So, okay, looking ahead, what are the concrete things we need to watch for in the next few months?
The first major hurdle is the Q4 2025 earnings release. We expect that in late January 2026.
The new management's first report card.
Exactly. Everyone will be scrutinizing gross margins, acquisition discipline, and any guidance on that AI pivot. If they miss here, the stock could fall back toward those analyst targets pretty fast.
And then in February 2026, we get the institutional 13F filings.
Which is arguably just as critical as the earnings.
It'll show us what the big money is doing.
Right. After all that November activity, all that dilution, did institutional money buy in for the long term, or did they just sell into the rally?
If we see major funds jumping in, that would be a huge vote of confidence.
It would. And beyond those scheduled events, the market is just, it's rife with speculative buzz right now.
Oh yeah, just rumors on forums, but they're influencing sentiment.
For sure.
The two most compelling rumors I've seen involve partnerships. First is chatter about a deal with a major mortgage fintech platform, if they could integrate financing right into their flow.
They capture the mortgage revenue. That would significantly boost those thin gross margins.
The other one that keeps popping up is a strategic partnership or even an acquisition by a major real estate portal.
Like a Zillow or someone similar, it's highly speculative.
But given Zillow's own history with iBuying and Opendoor's dataset, it would be a fascinating combination.
It would solve headaches for both of them.
There's also some buzz, unconfirmed of course, that the new board might be looking at a share repurchase program.
Now that they've stabilized things, that would be a powerful signal that management thinks the stock is undervalued.
And finally, geographic expansion. With more liquidity, they could start moving into new U.S. markets in early 2026.
Assuming the housing market plays along.
Right. That's a lot of potential upside built on, well, speculation and hope. We have to anchor this back to the major risks.
Absolutely, because those net losses didn't just disappear when the stock went up 1,200%.
No, they didn't. The primary risk is still there. Opendoor has never proven the iBuying model can be sustainably profitable.
The fundamental economics haven't been solved yet. They're still highly vulnerable. If the housing market softens or if the Fed holds rates higher for longer,
that 2026 break-in target is going to slip out of reach.
And we can't forget the leverage. Even after that deleveraging move, they still carry a lot of debt to fund all that inventory.
And that leverage is a force multiplier. Great on the way up.
Devastating when it moves against you. This is not an investment for the faint of heart. At the end of the day, Opendoor is a complex bet. You're betting on the new CEO executing a perfect pivot, and you're betting heavily on the Fed providing that macro tailwind.
So it's perfectly suited for investors looking for that high-risk, high-upside exposure to real estate tech. But success hinges entirely on management hitting that aggressive 2026 target.
It does.
And when we zoom out, that massive capital restructuring in November, that really was the inflection point.
It bought them time. It cleaned up their debt profile.
It set the stage for a potentially transformative 2026.
But the next few quarters, specifically the institutional reaction in those 13Fs and the Q4 earnings, those will be the true indicators.
If the big money confirms the retail hype, this could be validated.
And if they reject it, that huge gap between the analyst target and the stock price will become extremely relevant very, very quickly.
That is the full picture. Extreme technical momentum versus existential fundamental challenges. You need to follow this one closely. If you want more in-depth analyses like this one every week, make sure you hit that subscribe button right now to stay well informed on the market movers.